The weak affordability, the higher interest rates, the continuing high home prices led to a very, very weak year in 2023 in terms of overall home sales. This is math. If you sell a property today and buy a new one for exactly the same price as the one you just sold, you've now doubled your monthly mortgage payment. It's almost like you'd seen this before, Keith. Inventory is up significantly from last year, about 24% higher than it was a year ago. The weak affordability, the higher interest rates, the continuing high home prices led to a very, very weak year in 2023 in terms of overall home sales. We ended the year with about 3.9 million existing homes sold. That's the lowest number of homes sold in a year in a quarter century.
Yeah.
Even lower than we saw in the Great Recession. And December was the 28th consecutive month where we sold fewer properties than we sold the year before.
So a contraction in the number of sales, although prices appreciated last year.
Yeah, we'll talk about that. This year, I'd been hopeful that we off to a little bit of a better start. January and February were both up in terms of home sales on a month-over-month basis, but continued this trend of lower sales on a year-over-year basis. And so we're looking at 30 consecutive months where we sold fewer properties than we sold the prior year.
A result of this supply crash that really began about 4 years ago.
It's partly supply and it's partly costs. That affordability, we really can't overestimate the impact that affordability has had. But you're right in terms of inventory, and in fact, good segue. It's almost like you'd seen this before, Keith. Inventory is up significantly from last year, about 24% higher than it was a year ago, according to some data from Altos Research, but it's still only running about half of 2019 levels. So in a normal market, we would have about a 6-month supply of homes available for sale. In our market today, we're looking at somewhere between 2.5 and 3 months supply. That lack of supply with some pent-up demand is one of the reasons we have seen prices continue to be very healthy, and we haven't seen the price crash that all the snake oil salesmen on YouTube are trying to say. But as of mid-March, about 513,000 homes available for sale. Again, about 24% higher than last year when the numbers were just dismal. We normally do see more inventory coming to market this time of year. We'll not get anywhere near where we were back in years like 2019, 2020, but it wouldn't be a surprise to see a little bit more inventory coming to market.
Now, Rick, for existing properties, we have the very well-documented interest rate lock-in effect. I think a lot of people understand that. But as far as bringing more supply onto the market, do you see anything from the builder side? Costs are up for builders, and builders feel this lack of affordability from the buyer market as well. So therefore, that motivates them to build somewhat less, and they're also building smaller properties, some shrinkflation with new construction property to try to help out with that affordability. So what are your thoughts with builder motivations this year and next year?
Hold that thought, because we're going to get to new homes in just a couple minutes. Keep that right forefront in mind, but let's just kind of wrap up on existing sales. I do want to point out to your listeners that the inventory growth is actually outpacing the number of new listings. So new listings are only up about 14% year over year, whereas overall inventory is up 24%. The reason for that is it's taking longer to sell homes once they get to market. So once those properties are listed, they're staying in the inventory numbers a little bit longer than they were last year or even a few months ago. So that's one of the reasons the inventory numbers look a little bit better than they did. You talked about the rate lock effect. It's still very real. About 2/3 of everybody with a mortgage has a mortgage rate of 4% or less. And this is not home sellers being picky or having a psychological problem. This is math. If you sell a property today and buy a new one for exactly the same price as the one you just sold, you've now doubled your monthly mortgage payment. And most people simply can't afford to do that. So the properties being listed are by people who feel like they need to sell. There's a death in the family or a birth in the family. There's a divorce or there's a marriage. There's a job loss or a job that requires a transfer. Maybe some financial difficulties where the borrower's in distress, and so they feel like they have to sell the home. Or somebody's been retired for a long time, has a lot of equity, and just says, oh, the heck with it, it's time for me to downsize. The people who would normally be making a decision that maybe I'd like to sell, maybe I'd like to look at a move-up opportunity, those people are sitting on the sidelines And rather than seeing a price crash, which is what people are breathlessly trying to sell you on YouTube, the most likely scenario is something we've seen play out in the 80s and 90s, and is likely to play out again in the 2020s, which is several years of kind of lackluster sales volume and modest price growth. And it takes a few years to reset the levels so that all those people with the sub 4 mortgages gradually, slowly work their way out of inventory and are replaced by people with mortgages that are closer to today's rates. And we've seen that happen, like I said, in the 80s and 90s. And it's a very normal occurrence when you have a sudden shift in either mortgage rates or home prices. That's much more likely to happen than a 20, 30, 40% drop in home prices to make things affordable. And I would just ask anybody who's skeptical, if somebody approached you tomorrow and you didn't have to sell, but they said, hey, sell me your house for 40% less than market value, how interested would you be in having that conversation?
Wouldn't last long.
And then home prices are up in every region. You mentioned this, Keith, across the country. I'm sharing, for people that can see it, I'm sharing data from the FHFA, which is the entity that controls Fannie Mae and Freddie Mac. So all of those 30-year fixed rate conventional loans. On a year-over-year basis, we saw prices go up 6.3%. They were up in every region of the country. And that's a little different than the prior year when the Pacific region was actually down. But every region of the country is seeing price growth right now. And whichever price index you look at, Case-Shiller, Freddie Mac, the FHFA index, National Association of Realtors, everybody showed similar numbers where every region was up. But importantly, for your listeners, and I can't emphasize this enough, local results are very different than national results. So even within markets where we're seeing prices go up, there are going to be neighborhoods where prices are going down and vice versa. So it's much more important for you to understand what's going on in your local market than to listen to a lot of these national trends. I will tell you that some of the markets that overheated during the pandemic, as people were moving out of high-priced, high-tax, or highly congested areas, are seeing a bit of a clawback. So places like Boise, Idaho, and St. George's, Utah, and Austin, and Phoenix, and Las Vegas, we're seeing those markets with the prices clawing back a little bit. A lot of price growth continuing in the Southeast, the South, and surprisingly now in the Midwest as well. So we are still seeing a bit of a migration from high-price, high-tax areas into lower-price markets. I tell folks, Keith, I have 2 adult kids living at home. My son's getting married in September. He's a teacher, his fiance is a lawyer, and they took me aside recently and said, hey, you follow this stuff. What states should we be looking at outside of California to move so that we can own a house?
Wow, that is really, really interesting that would dictate their decision on where they live if they have that much of a preference to own rather than rent. Recently, a lot of us in the industry learned that the average age of the first-time homebuyer is now 36, older than ever.
And these are 2 kids with good heads on their shoulders, so they know the benefits to home ownership. And they also know that the median price of a home sold in California last month was almost $800,000. And the First National Bank of Dad ain't financing that acquisition. So, but I'm sure these conversations are happening in New York, in Chicago, in Miami, and in San Francisco. And it's just the reality of today's marketplace. We talked about prices going up. We are seeing slightly more homes having a price reduction before they're sold. That always happens somewhere along the lines of 30 to 35% of homes listed wind up with a price reduction before they're sold. We're up to about 31% now. So we're still in the normal range, but we're a little higher than we've been in recent months.
This is interesting. A statistic we don't talk about very much, the percent of homes experiencing list price reductions.
And it peaked in 2022, the highest number we've seen in quite a while. It was over 40%. And that was right after interest rates doubled. And so it's probably not a huge surprise. People were anticipating, they were pricing based on the prior market. And I think we're seeing more rational pricing today. But again, that combination of prices just being as high as they are and interest rates being as high as they are creating some affordability issues. And for people that have to sell, they're taking price reductions. Now, keep in mind, these price reductions are often very, very minimal. In California, for example, the average price reduction is less than 1%. So it's not a huge reduction, but it's still a reduction from what the list price was. You asked about new homes. So now I'm going to make you happy and we'll talk about new homes. New home inventory levels are increasing. We normally want to see about a 6-month supply of existing homes for sale. The new home inventory is usually between 7 and 8 months, and we're back to that number right now. Some of those homes available for sale are still under construction, but they are nonetheless available for sale. And we've seen that inventory improve over the last year as supply chain disruptions have minimized, as builders are now more able to find laborers for construction. Those are two huge holdups they had over the last couple of years. And we've seen new home sales increase. And one of the reasons for that is they're available. So if you're a builder and you put a home in a market at the right price, you're going to sell it because there just aren't that many existing homes available for sale. And to your other point, Keith, new home prices are actually down 15% from peak. So existing home prices are up, new home prices are down. And in fact, if you look at the most recent new home pricing data put up by the Census Bureau recently, new home prices are at the lowest level since June of 2021. So they've really come down pretty significantly and are not that far away from existing home prices in many markets. So that median price of an existing home and the median price of a new home for sale are closer than they've been in years. Partly because the builders are building smaller homes, partly because they're using less expensive fixtures. And the other thing that the builders have been doing, and this surprises a lot of people, but it's brilliant on their part, is they're coming to closing with thousands of dollars and they're paying down mortgage rates. They're buying points and dropping the mortgage rate for their buyers. I spoke to a group in Denver recently where there was a local builder advertising mortgage rates of 4.99%. So,
Yes.
think about that.
We have providers we work with here that are doing similar things. We're still seeing the rate buy downs happening. And that's why I've often told people, Rick, like this is potentially a good time in the cycle when you're adding more rental property to really look at new builds or build to rent while these rate buy downs last. Now, I talked to a builder in Houston yesterday, and I learned a few interesting things. You talked about the smaller square footages. They could confirm that. Oftentimes, this builder offers either a bedroom or a study. You can get an extra bedroom or a study, like a little office space. And more people are opting for the study. So they're starting to build homes more with the study in mind because more people are working from home, and
Yep.
one less bedroom because people are having fewer children.
Yeah, exactly right. And it's the combination of both of those two things, either having fewer children or having them later, and many more people working from home than they were prior to the pandemic. And those studies become very, very useful rooms to have in the house.
Rick, what is the lowest cost new build single family home that you see? I mean, is anyone even building in any parts of the nation like a 225K new build home? I haven't seen one.
I haven't seen one, but I wouldn't be surprised if you're in a market in a state like Alabama or Mississippi, and some of the more outlying areas, maybe some markets in the Midwest where home prices aren't as astronomical as they are elsewhere. But look, the builders are building judiciously. They're not overbuilding. We had a cycle in 2008 where we had a 13-month supply of homes available for sale.
Yeah,
The builders
gosh.
never stopped building. They got caught with overstock. But what they are building, they tend to build as move-up homes because they're more profitable. So you're just not seeing an awful lot of entry-level homes being built. And the hope is that as they build that first move-up level home, some of the people with entry-level homes will opt to sell and bring some of that inventory back to market. We are seeing more construction. We are seeing building permits going up on a year-over-year basis. Most recent numbers are around 1.5 million permits. So the builders are bullish on the future. And housing starts were up in both January and February. Most importantly, they're up most strongly in single-family owner-occupied homes. We're seeing housing starts decline dramatically in terms of multifamily starts.
Right.
But that's because there's about 1 million new apartment units coming online between last year and this year, and we don't need a whole lot more apartments. We need more single family homes. So if your listeners are seeing headlines talking about housing starts being lower, it's really because we're seeing fewer multifamily starts.
Last year was a big year for multifamily construction.
All-time high in terms of multifamily units under construction. And a lot of those are still coming to market this year. There are going to be some markets that are actually a little oversupplied. So again, you have to be paying very close attention. We're talking a little bit about the rental market. In the apartment category, we have seen apartment rents decline year over year in pretty much all categories. Whether you're looking at studio apartments, one-bedroom apartments, two-bedroom apartments, on a year-over-year basis, rents are actually in negative territory according to Realtor.com and according to some data I've recently seen from RealPage. If you're looking at the actual price of rent, and I know that's a little different than percentage increases or decreases, you're still seeing that rent's about it's below peak. It's about 1.6% below the peak we hit in 2022 when vacancy rates were just about nothing. But we are still below peak, and the median rent is ranging somewhere in the neighborhood of $1,700 a year for apartments. Single family homes, which I suspect more of your listeners are actually renting out than apartments, are
Yes.
doing better. We're seeing year over year rents continue to grow. They're growing modestly, but they have not gone into negative territory, and they haven't during this boom and bust cycle that we've seen in the housing market. And if you're looking at price gains, according to some recent data from CoreLogic, if you're at the higher end of the single family rental market, prices are up about 3% year over year. And at the low end, they're up about 2.9%. So very little difference depending on your price tier. And also very little difference depending on whether you're looking at an attached single family residence or a detached single family residence. All those are up right around 3% year over year. And that's a good sign. Again, you're dealing with as your listeners know, you're dealing with a slightly different tenant in a single family home than you are in an apartment. And a lot of these people who would have been buyers are opting to rent. Stands to reason that they'd rather rent a house, particularly if it's in a good school district or in a good neighborhood, than an apartment because they have needs.
Rents are extremely stable. Historically, they just sort of plod up slowly. What happened about 2 years ago, 3 years ago with that 15%
Yep.
plus rent increase? That's an aberration.
Yeah, and that's a good point, Keith. If we're looking at 3% rental growth year over year right now in the single family rental market, that tracks with historic normals. Usually you're somewhere between 1% and 5% a year, so three's smack dab in the middle of all that. And the growth rates also vary wildly by markets. Just kind of give you a range. If you're looking at a single family rental property in Honolulu in the city, year over year, you're up about 6%. If you're looking at a unit in Miami, Florida, you're down about 2.5%. So
These are rental growth rates.
rental growth rates. So it really just depends on where you are. That's pretty much your range from a couple points down to, I think Honolulu actually had the largest increase in the CoreLogic study. A lot of your listeners are probably interested in buying foreclosure properties. We're not seeing a lot of foreclosure activity still. We are starting to see a little weakness in consumers. When we met last week, we talked a little bit about the strength of consumer spending, but we also talked about increasing amounts of spending on credit cards. And we're seeing consumer delinquency rates increase in pretty much every aspect of consumer lending, whether it's a loan, whether it's a credit card debt, whether it's an auto loan, whether it's a home equity line of credit, whether it's a mortgage. Mortgage delinquencies are up a little bit. The only category we're not seeing an increase in delinquencies right now is student loans. And my theory on that is that people have only recently had to start making payments again on student loans, and we just don't have enough data to show that they're going delinquent yet. The delinquency numbers we need to take with a grain of salt because most of them are early stage delinquency. So somebody's missed a payment, but then they catch up before they get 60 or 90 days delinquent. But we are seeing trends that suggest more delinquencies. And if you have more delinquencies, it leads to more foreclosures. Mortgage delinquency rates, according to the Mortgage Bankers Association, went up to about 3.8% in the fourth quarter. The historic average, going back to the 1970s, which is as far back as the MBA goes, is about 5.25%. So we're still way below normal levels of delinquencies. As I mentioned, most of those are early stage delinquencies, and they're being resolved before they get more serious. And because of that, we don't have a lot of foreclosure activity. So this is no longer, Keith, government intervention. It's no longer government forbearance programs and foreclosure moratoriums. It's the fact that the economy has been so strong. Unemployment rates have a very strong correlation to mortgage delinquency rates. We got together last time. I mentioned the unemployment rate was at 3.9%. I just told you that mortgage delinquencies are at 3.8. Can't get much closer than that. And because of that, foreclosure activity is still down almost 30% from where we were in 2019 prior to the pandemic. And I should point out that 2019 wasn't a particularly big year for foreclosures either. So I don't see us getting back to pre-pandemic levels of foreclosure activity until sometime next year. And what's important for people in this space to understand is that even though we're seeing roughly the same number of delinquencies that we saw back in 2019, fewer of those delinquent loans are going into foreclosure. Fewer of those foreclosures are getting as far as the auction. And even fewer of those are going back to the banks as REO properties or bank-owned properties.
Delinquency
So,
occurs before foreclosure. We have low levels of both. And I would imagine that one substantial reason for that are these low fixed rate payments that so many people have. Minutes ago, you showed us that 90% of those with a mortgage have a rate in the fives or less. And then oftentimes when we talk about these sorts of things, we don't even consider the fact that more than 4 in 10 homeowners are free and clear. They don't have any mortgage at all. So it's difficult for people to get in trouble.
yeah, and when they do get in trouble, what's really a saving grace for a lot of these people, and I believe the reason we're seeing fewer foreclosure auctions and bank repossessions is that there's $31 trillion in homeowner equity in the market, and 90% of borrowers in foreclosure have positive equity. A huge percentage of those have at least 20% equity. So what's happening
Interesting.
is that many of these borrowers are protecting their equity by selling their home before the foreclosure sale. If they get to foreclosure sale, they run the risk of losing all their equity or at least the overwhelming majority of their equity.
Well, that's a
And if
great
you're
point with how this really
Yeah.
works.
And so if you're looking to buy a distressed property, if you're looking to buy a foreclosure property, you really need to be working directly with the homeowner in the earliest stages of foreclosure, rather than waiting for the auction and certainly rather than waiting for the bank to repossess the home and resell it. And some recent data from a friend of mine at auction.com, tracking some numbers from Adam data. 55% of the distressed properties that were sold from June through September of last year were sold in that pre-foreclosure period prior to the foreclosure auction. That's wildly different than we've been in years past. So really important for anybody looking to buy a distressed property to consider moving upstream and working directly with that homeowner. And it's a win-win. You can help that homeowner protect their equity, have some cash to make a fresh start with, and typically buy a home in pretty good condition and a home that you need to be part of your rental portfolio. So just kind of recapping some of the stuff we talked about, Keith, both today and last week. I still think that from an economic standpoint, there's still at least a good possibility we might have a short, mild recession sometime later this year. Don't see unemployment going much higher than 5%, even if we do have a recession. And if we don't have a recession, we'll at least see the economy slow down a bit. It might be hard to tell the difference. I'm expecting the volume of home sales to go up. I think we bottomed out in 2023, but not by a lot. Maybe we see a 10% lift over last year, which would take us to roughly 4.4 million existing homes. I wouldn't be surprised to see 700,000 new homes sold. Really just depends on how quickly builders bring inventory to market. But if I'm right and mortgage rates go down slowly over the second half of this year, we'll see more home buyers come to market more quickly than sellers. I think we don't see a lot of sellers come to market until we get interest rates down to about 5.5% or lower, which probably won't happen until 2025. So more buyers coming to market than sellers means the prices will continue to go up. We continue to see investors account for 25 to 30% of all residential purchases. So I think we'll continue to see a high rate, partly because investors are active, partly because a lot of consumers are waiting for market conditions to improve. But that limited affordability in today's market conditions, I really do think means more demand for rental units. And I think foreclosure activity stays below normal levels for the rest of this year. And REO inventory, bank repossessions are going to remain even lower for even longer. I don't think we see REO activity come back to more normal levels for at least a couple of years. So anybody looking to buy these properties really does need to be moving upstream in order to make those purchases.
Yeah, with low affordability, hence more demand for rentals, I've already noticed that the home ownership rate, which is somewhat of a trailing number here, has already fallen from 66% to 65.7%. And with low affordability, it seems that that home ownership rate could fall even more, meaning the rate of renters would be higher.
A friend of mine always complains that the government's somehow behind all of these trends, one way or the other, and wonders why, with all the government programs aimed at increasing home ownership, we haven't seen that home ownership rate increase much. And I think sometimes things set at a natural level, and our home ownership rate really for the last 30 years has been somewhere between 64% and 66%. And that might just be what the natural level for home ownership is in the United States. Will it dip a little bit as people can't afford to buy a house? Probably will. When market conditions improve for buyers, will it go up a little bit? Probably. But we hit 70% home ownership back in 2006. And it turned out that was the bad number. And
Right?
that not everybody's ready financially for the kind of commitment that home ownership requires. And so I've always said the key isn't getting everybody into a home, it's the sustainability of home ownership for people that we do get into that house. One of the best days of your life is when you get the key to that house, and it has to be one of the worst days if you have to give it back. So I hope we all keep that in mind as we move forward.
That's right. Government incentives in the past, say there's a $10,000 first-time homebuyer tax credit. Oh, we're not in an era where we need help on the demand side. All you're doing is driving up prices, and I don't know that you're helping out anybody in that case. But I think with really overall, one big takeaway here, Rick, is that if you, the listener, the viewer, if you're waiting for prices to drop substantially sometime or for interest rates to drop substantially sometime, that might not be worth the wait. You could be waiting a long time.
I do expect mortgage rates will decline. I don't think
Yeah.
we're going to get back to the sub 4 rates we saw a few years ago, but they're going to decline slowly. And they may not decline enough to offset rising home prices. I mean, you have to get your calculator out and figure out how that math works for you. But you're absolutely right, Keith. And I tell people today, even with mortgage rates being where they are, if you find a house you love or you find a house that's a good investment and you pencil it out and the numbers work, don't wait. Because the opportunity cost can be severe, and you could wind up missing out on a property that could either be a good cash flow unit for you on rental, or could be a property that you wind up living in for the next 30 years. So don't be afraid of today's market. Just be very prudent and judicious in the way you approach it.
Well, Rick, Get Rich Education followers in the nation have been a beneficiary of your housing market intelligence expertise for quite a while now. If someone wants to engage with you in the CJ Patrick Company, who are those types of people and how could you help?
Yeah, I appreciate the opportunity, Keith. Most of the companies I work with are companies that provide services to the real estate industry, are lenders, or are people or companies that provide services to lenders. So anybody who has a business that's in the real estate or financial services markets who would benefit from my coming in to share with them industry data or has data themselves that they would like to get out into the marketplace. Anything data related, really, I tend to specialize in. So market updates and market overviews and market analysis are things that I do on a pretty much daily basis for companies.
How can they engage with you?
Oh, they can find our website, which is cjpatrick.com. They can find me on Twitter. I hide there under my name, Rick Sharga, or reach out to me on LinkedIn. And if you reach out to me on a social media channel, make sure that you mention you know me through Keith, and you're not some crazy Russian bot trying to hack into my personal information.
Well done, Rick Sharga. It's been great having you back on the show.
I'm sure we'll do it again sometime soon. Thanks for having me.
You can watch this one next.